that you can download and have already. We're going to launch some polls as well throughout this webinar, so we want in your feedback from yourself and from everyone that's on the webinar today. So let me just get started and introduce Summit Global. Summit Global is a investment manager. We're based out of Utah, and we specialize in what's called low volatility investing. And I'm going to explain a little bit about why we do that, what's our methodology and reasoning behind that, and also give a market update, what's going on currently in the market. Let me start a bit more about low volatility and why we think it's so important, not only in general with investments, but also why it's important right now with investments. And so if you come with me here as we go to the next slide, this is really financial theory. So back in 1954, late 1950s, a gentleman by the name of Harry Markowitz published a lot of academic papers on portfolio selection and on portfolio risk and return. And in general, the gist of all of his papers was talking about this relationship right here between risk and return. And what he said, and what all this, in summary, what they said was that there's a positive relationship between risk and return. And this has been very, very true across asset classes. So if you look at asset classes like, for example, you look at stocks versus bonds, taking a look at those, stocks in black here you can see have been much more volatile than bonds in red. Yet stocks have outperformed bonds. Again, more risk, more return. Bonds have been much more volatile than the flat line there, like a CD or a savings account, but they've outperformed it over the longer term. And so what Markowitz did for us is he set up this framework how we manage, 80 years later, how we manage money today. And so more specifically, when we have a client that says, hey, I have X amount of risk, the first thing that you do in looking for the client is help them to either have some exposure, no exposure, a little exposure to different asset classes. So if we have somebody that comes into the office and says, hey, I'm really, really conservative, and I just cannot lose any money. This is money I'm going to use next month to pay my house bill or pay my groceries or whatever they have and their reasoning behind it. We would look at the asset classes to help set that up. On the other hand, if somebody said, hey, I'm really aggressive investor, obviously we would look for something like more equity exposure, understanding that they can take the volatility in order to get the better returns. The problem lies in going from across asset classes into asset classes specifically. So now what we've done as individuals and as the community and the financial community is we've kind of institutionalized, if you will, and cognitively we all believe this risk and return has a positive relationship. And the problem is that when you look within stocks themselves, that does not hold. So if we look at stocks themselves, the reality is that the theory across asset classes is positive. We cognitively think that's the same for stocks, but when we look and pop the hood on stocks, we find that it's actually negatively correlated. In other words, the more risk that we take in stocks, the more money we lose. And so that kind of turns everything on its head with regards to how to manage money when you then say, hey, let's give you exposure to stock. Well, the difference is not the exposure to stock. The difference is how you manage the equities that you have or that consist of that exposure. So what it sets up is a couple different myths and realities about investing in the equity markets. The first one is that low risk equals low return. And the reality in the equity market is not true. The other one that we have, and I don't have it on the slide here, is that high risk equals high return. That's also false. The only thing that's really true that we can say that we know for certain is that with great risk, if you take more risk in the equity market, the one thing you're certain of is getting greater risk. So having set that up, let me go through a little bit of examples here to kind of drive this home and show you why this works. So first, mathematically. So if you look at an investment, and let's say you have $100, and you want to put that money to work for you. And so you've looked at your risk perspective with your advisor, and you've sat down and you've said, hey, where would I like to put this $100? And they decide to put it in the stock market. Now, if you put it in the stock market, let's say you're going to keep it in there for 2 periods. And looking at these 2 different type of portfolios, one we're going to use a higher risky portfolio, or volatility, another definition for risk, or lower volatility, lower risk portfolio. So the first one, we put in $100 and you return 50% negative. Obviously, you're not happy with that investment at all, and your $100 turned into $50. But the next period, you keep it in for some reason, I'm not sure why, but you keep it in, and the next period it goes up 100%. So your $50 turned back into $100. Now there's 2 things that I hear over and over again from our clients that they care about. And the first thing they care about is return. So luckily in this case, at least you didn't lose any money, though you didn't make any either. The second thing they care about a lot is how they get the returns they receive. How comfortable are they in receiving those returns? And in this case, you were very uncomfortable. So taking that same $100, and let's just cut the risk in half. So instead of going down 50%, you go down 25%. Now you have $75. And instead of going up 100%, you only go up 50%. Well, now you have 100, and you have more than $100. Specifically, you have $112. So that now you've made money on your investments, if that makes sense. And so the key here is that you were more comfortable and you made more money, because mathematically you did not go down as much when the stock market went down. Maybe another example to kind of make it a little bit clearer. So in this case, what we're looking at here is the S&P 500. And again, the S&P 500 in stocks here, representative of the market as a whole. We know it's been the most volatile over the last 40 some odd years, in this case 46 years. And we know that it's also made the most money. So in this case, if you put in a $10,000 one-time investment in January 1st of 1970, today you would have $242,000. A pretty good, decent return. But now let's talk about how to make money in stocks. If the one thing I've learned over the last 20 some odd years managing money in equities is that one of the keys is actually not losing money. Protecting yourself on the downside is more important than trying to maximize your upside. And so in this case, let's say every time the market declined, that this investor, instead of going down 100% with the market, went down only 55%. So if the market went down, say, 10% in a certain period, okay, they only went down 5.5%. And the reverse, let's talk about the upside. Instead of going up 100% with the market, they only captured about 80% of an up market. So if they only went down 55%, but they then went up 80% of the up market, what would their returns be? And it turns out that they would have over $1 million today. And that's a big difference. And why does this unmanaged portfolio that's in an index get outperformed by something that's more of a managed risk approach? And the secret is because it's capturing less of the downside. It has better downside protection. And if you think back to the 80s and 90s when the market was really going up, and from 1982 to 2000, the market was up over 1,000% return. And you heard all the time, if you turned on the radio or what have you, or the TV, they talked about how monkeys were outperforming the pros, and at times the dartboard was outperforming the pros. And one of the reasons why is because when the tide comes in with stocks, when stocks rise, all boats rise. But it's not the same when the tide goes out, or just when you're open water. In other words, if you have a hole in your boat and your stock goes down, then it makes a big difference. So protecting the downside is much more important than trying to capture the upside, if that makes sense. So what does it mean? It means that because of this, not only can you make money within equities, but you can do better than the average investor. If I met with the average investor and they had not received professional advice and they do not have an advisor, I find that over the last 10 to 20 years, I can almost predict their returns within a percentage point or so. And the studies show that they return about 2% a year on average. And that's sad. That says, hey, we need to do a better job in our profession of getting the word out there that you can manage money and actually be successful at doing it. And two, there's a lot of people that need our help. So having said that, let me show another reason why we got into the business of providing asset management services in this low volatility manner. So the other thing we looked at back in 2008 was conservative allocations by Morningstar. So we looked at every single one of the Morningstar mutual funds. And the average return from these mutual funds rated by Morningstar as conservative was actually negative 25%. And to me, who's in a situation in 2008, for example, that my father came and said, hey, I'm really struggling here. I'm retired. I have my money in the market, and I'm getting beat up even on my conservative strategies. To me, that doesn't sound very conservative. Even in a conservative allocation that has like 30% exposure to stocks and 70% exposure to bonds, that's still leaving people down negative 15% during the great financial crisis. That doesn't sound too conservative to me. And so this protecting, this lower volatility type of investing, I believe is very, very important. And one of the reasons why these things go down so much is due to the fact that they take on too much risk. If you pop the hood and looked at the typical allocations within conservative models and aggressive models, you're going to find market timing, you're going to find leverage, derivatives, people taking long short positions, high risky bonds or aggressive stocks. And one of the things that I see is that they're taking risk, and what does risk do in the equity markets? It tends to lose them more money. So instead, what we do is we take a managed risk approach. We use a low volatility type of approach with stocks. We try to be prudent. And this is across our stocks and our bonds for our conservative investors to the more aggressive investor. So having said that, let me just stop for a second. That is, in essence, why we manage the way we manage. That's the philosophy behind why we do the things we do, because we believe that we can receive the similar or sometimes even better returns than the market and do it with a lot less risk. And so I'm going to throw a poll out there that I'd love your responses on and your questions on and things of that nature, and I sent that out to everybody. Please take a minute and fill that out and tell us what you think. But I'm going to move on, and I'm going to talk now about the markets. So there's 4 general macro things that really drive the markets. And I'm just going to spend a minute on each of these, and this is kind of our current view right now. So if we look at the market today, it's really being driven by 4 things. The Federal Reserve, Congress, or Washington we'll call it, or the rhetoric that comes out of Washington and the laws, economic and earnings data, and the global unrest. And so let's just take these right now. The Federal Reserve, I'm kind of giving an equal weight to positive, maybe a little bit more positive than equal weight, but the Federal Reserve right now is having a good effect upon the markets. Now, they're going to speak. They're at Jackson Hole, and they're going to be speaking here momentarily, and the market's kind of on hold right now waiting to see what they say. But I would expect them to say, hey, we're going to raise interest rates. I would expect the market to be a little bit negative off of that news. It's going to sound like they're going to raise interest rates in September. I don't expect that whatever. And I think that maybe there's a 50-50 chance they raise interest rates in December like they did a year ago. I think that that's what you can expect from the Federal Reserve. But I don't think they're going to do anything very, very quickly. I do think they're feeling a little bit pressured because the market over the last 6 months is up 20%. So there's some positive notes. I think they're going to speak positively about the markets, and they're going to talk about being able to raise interest rates. Overall, because they're supportive of the markets, the Fed tends to impact markets short-term and long-term. On the other hand, Congress tends to impact the markets negatively, and they tend to impact them very short-term. They really don't impact markets long-term generally. They have before in the past, and right now the rhetoric out of Washington and the rhetoric out of both different presidential parties and the risk that's being applied to those different parties right now, I'm giving that a negative. In fact, I think in essence, and I'll show you some charts here, how the market is, I think, eerily too calm for maybe the risk that's at hand. The other one is global unrest. Hey, the companies in the U.S. today are more globally connected than ever before. And so anything that happens in Syria or the earthquake in Italy or other things that happen across the globe impact our markets here. And so if we look at that specifically, I would give that an equal weight right now in the sense that, hey, there are some hot spots around the country, but those are known and they're somewhat not really escalating. And so we know about the situation with North Korea and the South China Sea and et cetera with ISIS. The fact is it's not escalating as much as it has in the past. And so I'm giving that more of a neutral. And that tends to impact the market short term, not really long term. Going back, the earnings and economic data that comes out on a regular basis is what really drives the market long term. And so if you look at the earnings and economic data, it's somewhat mixed. I would put it slightly negative. And so my overall view, when you add these all up, I would be kind of neutral on the market to slightly negative because we've had such a good run and the way that the market's set up right now. And so let me show you that. So if we look at the earnings data, we're getting very long in the tooth. We're at about 80 months right now. This is a few months old. We're at about 80 months right now between recessions. That's the fourth longest time that we've ever went between recessions in the U.S. So we're doing, the Fed is impacting us. We haven't had a recession, but I put over the next 12 months of a recession probably at about 50% right now. And that's because we're getting long in the tooth. If you couple that with what's going on globally and what's going on with, like, say, for example, China's been trying to devalue their currency. And sometimes they've done it very, very well. And other times, like a year ago in August, they didn't do it very well and the market was sold off considerably. And China represents about 30% of the world GDP. And let me just see here. I just got a message that maybe you guys cannot see the slide. So I'm going to go back here a little bit and make sure that you can see these slides. So here's the economic situation, how we're between recessions, we're getting long in the tooth. I talked about that. Here's the input of global unrest across the world. We talked about that a little bit. And here's the slide around the 4 things that drive the market. So going on, I want to talk about China, and I was just talking about how they represent about 30% of the world's gross domestic product. So if they're having problems, which they are, it impacts our U.S. companies. And then 2 other slides that I think are really important. The first slide here is the slide on the market risk. This is using the VIX, which is kind of a measure of the market risk. And you can see from this slide that it's at the bottom of the range. In fact, currently it's lower than where that's at right now. To me, this represents an underpricing of what risks are really out in the marketplace today. It's too calm. So if you look what happens when it's too calm, it tends to spike. And when the VIX goes up or risk goes up, the markets go down. And so the reality is, right now, I think the market's underpricing risk. And it reminds me of, like, the underpricing of risk with internet companies back in the late 90s. Pets.com, it's worth $2 billion just because it has a .com on it. And do they even have an office? No. Do they have a website? No. But it's worth so much because it's a technology company and there's no risk. You should put money in it. Well, when we find situations where people are underpricing risk, to me, that's actually risky. And that's what I see going on right now in the markets over the last 6 months. Also in the markets, if you look at the earnings of the markets versus the price, we're getting expensive. And so we're up more towards the higher end of the range when it comes to the price of the stocks in the market. So to me, when I say I have a neutral stance to maybe slightly negative, I guess when I look out, I see kind of more cloudy skies ahead. And I really, really want to make sure that when we have turbulent waters or fluctuations in the market, I protect. But because I don't know, like the last 6 months we had an up 20% market, I still want to be invested in the market. I believe in the resiliency of companies and people and productivity in the U.S. And so I want to take advantage of that. And those are the things that I think really drive the market. And so, in essence, how do you make money in stocks? You have to protect your downside. And so I want to take a minute here, and I know we're running short on time, just getting towards the end. We've got about 10 minutes left. But I want to go through the last 2 years of market declines and show you kind of not just the methodology or the philosophy, but the reality of how we've done and what the markets have done. Because proof is in the pudding. And so let's do that together. So first, let's look at the invasion of Ukraine and the peninsula there. The markets sold off when that happened, and in general, the markets were down about 3.2%. This is the representative black line is the S&P 500. It was down 3.2% from March 10th to April 11th of 2014. What did SGI do? This is our aggressive strategy. We were negative 0.3. So how much of the downside did we go down? We only captured 9%. We did very, very well. The next down market that came into play was in September 9th through October 15th. This situation, people thought that they were going to take away the candy jar, if you will, and that the Federal Reserve was going to end quantitative easing immediately. Well, they didn't, but nonetheless, the market reacted pretty violently here. It was down over 6.5%, and we were down 3.79%. Right about what I talked about earlier, 56% of the downside capture. Once the market found out that the Federal Reserve wasn't going to take away the candy jar, if you will, the markets immediately shot back up. And from October 15th to December 5th, the markets were up over 11.4%. Hey, SGI, how did you do? We were up over 11%, over 96% of the upside capture. If you capture just 50% of a down market, to outperform, you only have to capture 66% of an up market, just mathematically. So the secret is to make sure that you have higher lows so you have more money there to work when the markets go back up. The next down market is in January 2015. The market sold off. People were worried about the rise of the dollar and interest rates. Surprise, surprise. We're still hearing some of that today. And the markets were sold off negative 1.8%. Hey, SGI, how did you do? We actually didn't lose any money. We were positive 0.57 in our aggressive strategy. And so consequently, what is it? Correlation? Well, there's no downside capture. We're actually negatively correlated here on this protection. The next one is last year at this time. Last year at this time, the markets were in a downfall and in a spiral, if you will. The markets were off almost 7% for the third quarter of last year. This was due to many reasons, but a lot of it was due to what we're experiencing today as well. In that volatility, hey, SGI, how did you do? Well, we didn't lose any money for our clients. We captured 0% of the downside in our aggressive strategy. And so this is the protectionism that I'm talking about. Let me go through this year. In the first of this year, you probably remember even clearer when the market sold off even more. So very much a market inflection point on December 29th. And from December 29th to February 11th, the market sold off 11.75%. Hey, SGI, how did you do? Well, we were down 55% of that. But when the markets rebounded, immediately coming back up, and in March, the market was up 6.7%. Hey, SGI, how did you do? Well, we were up over 6%. We captured over 90% of that upside. And that's what you want to see from a manager in the sense if you're going to put money in stocks because your risk can bear it, then the reality is how you manage money in stocks is very, very important. And let me make one other point too. I'm going to go back to a slide here that I showed earlier. And this slide shows just the different volatilities of equities versus bonds. If I have a portfolio and I'm an investor, what drives my returns and what drives my risk more than anything else? The reality is my stock exposure. Even if I just have 10% or 20% exposure to stocks, it still drives my risk and return. So if I'm really concerned about my financial situation, where I put my savings account is not my biggest decision or most important. Who I hire to manage my bond portion of my portfolio is not your biggest and most important decision because it's not going to impact you. If you get the world's worst bond manager versus the world's best bond manager, there's not much of a difference. But on the other hand, if you hire the worst stock manager, that will make a huge impact upon your savings and your investments. And so who you hire to manage your stock portion of your portfolio is really what makes all the difference. And that's what we strive to do here and specialize in, is this downside protection while maintaining equity exposure to give you upside return. And so if you look at the first quarter, the first quarter of this year, the market sold off, like I said, came back and was still negative. We were down, but only about 50%. So therefore, when we came back, all of our clients made money in the first quarter. And in the second, and where we're at year to date as well, we're outperforming the market. And so let me just show you what that means when it comes to all of the different, money managers in the marketplace today. What happens? Well, we're rated a 5-star by Morningstar, which is their highest rating. We're in the top percentile of money managers in the U.S., and that's what's going on. And what we're trying to do, in essence, and to kind of wrap this up, and I'm going to send you out another poll here, and that's that we're trying to provide a peace of mind with your equity investments and an opportunity to take advantage of the markets, while at the same time knowing that we're very conscious about safety and we're very actively managed. The other day someone asked me, hey, well, isn't your strategy then just like rearranging chairs on the Titanic or something? So when the Titanic sinks, you're just up there trading in and out of stocks? And the reality is that what we do is completely different than that. We're not traders. What we are is investors. And we're actively looking for stocks that do not have downside catalysts or characteristics. And so we're like going on the Titanic, if you will, and we're actually the ones that are inspecting all of the lifeboats. Which one has the most air? Which one has the most, if you will, life preservers and life vests? Those are the things that we're investing in. They travel with the equity markets. The tide rises all the returns. They do a good job. But when the markets go down, oftentimes our stocks can actually be bid up. People want to get into those life rafts, if you will, and that's where we're at. And so we feel like our strategy of taking less risk and getting similar return, or as our trademark says, reduce risk, retain returns, is a very, very prudent strategy for equity investors. From SGI and from Summit Global Investments, we value your perspective, we appreciate your trust, and we hope to earn that on a daily basis. Thank you very much, everybody, and thank you for attending the SGI Low Volatility webinar.